Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, March 19th, 2024. It is 12:37 p.m. Eastern Time. I'm starting the video, and I'm going to do a quickie here, just kind of update on the markets, what to watch for this week, and of course reiterate the fact this is a Fed week. Reiterate the fact that the Fed is not going to change interest rates, but what they say afterwards, especially Powell's press conference at 2 p.m., which follows, 2:30 p.m. that starts, follows the 2 p.m. rate announcement. That has the impact to really make or break things where we're at. So let's dive into the charts. I'll just do an update. And I'm going to show you a new chart, something, it's kind of a spin on what I've been talking about, but I think it's almost everything right now. A very important and simple chart to track. All right, so what I'm going to do is, what I like to do is go through some of the recent questions. I'm just going back the last couple days here. This one I made, this was a reply I made yesterday. I might even have covered it in yesterday's video. In the morning, get the, QQQ offers an objective short entry off the 60-minute uptrend line with a higher probability, a higher probability sell signal from Friday's video, which is a break below that Friday's low around 433. And again, to reiterate from last week's analysis, we have several key market-leading stocks that still need to take out their yellow levels, and I need to see QQQ and SPY take out Friday's low for what I call a high probability sell signal for a swing and trend short. Okay, none of the 5-minute charts. Active traders, I've been having having a field day with this market lately. You can just bounce. It's like a game of ping pong. As long as you're able to hit the ball back, and see where it's coming in at, you can just get these 1-2% trades. I'll get to the short-term charts in a second. But again, this is for those that don't have that time, inclination, luxury, to sit in front of the computer all day, or again, don't care to do that. Okay, so blah, 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 short of the back of the downtrend line. There it was yesterday, QQQ. Can I zoom in? I can, then I have to move everything over. Let me just go back out. You can see it there. We were right on the trend line. All right, so let's do an update now, and this kind of plays into where we are today. So that was it yesterday. If you shorted the back test of the trend line, you made a quick 1.7%. And then if I've said it once, I've said it 1,000 times lately, this is big support, Friday's low. So it was a no-brainer. That was again, if you go back to the post, arrow breaks denote a level of a likely reaction. And I did that one white because, that's what was going to happen. The yellow is what will happen, and for swing traders. So it's kind of why I did change the color up. That was okay. Short it, take a shot if you want a quick pullback trade. And an arrow break means a reaction, meaning we're going to hit there again. If I didn't think we were going to get another reaction, I would have had a solid arrow going down. And the fact that I didn't think we had everything to do with the Fed and the next question I'm going to roll into. So again, those are your targets if and when 433 goes. And as I, again, to add on to what I've been saying here, I already updated SMCI yesterday. Somebody, there it is, NQ hanging around 18,300 thoughts. Here's my thoughts. Nothing much that happens between now and Wednesday's FOMC/Powell press conference matters. Markets are likely to grind around with whipsaws above and below support and resistance levels to then. And so I went on to add, I do think NQ 1800 is a pretty key level. It's pretty much that same as the 403 or whatever it was there on QQQ, 433. And that's it. So bullish if they can hold above it and rally from there, even if we get a pre-FOMC false breakdown first, and bearish if 1800 goes for good, especially after Wednesday. Why especially after Wednesday? Well, if it goes today or before 2 p.m. or 3 p.m. tomorrow, there's a very good chance it's going to prove to be a whipsaw, because again, the Fed, what they say, can override anything in the chart. So that's kind of the takeaway. You can trade it. You got to be nimble. Just bounce, go for a little quick 1% here and there, bounces off support or pullbacks off resistance, and then kind of maybe go into cash into the FOC. I'm speaking active traders there. Swing traders, I've shared for a while now. I'm short, ready to go heavy short or all in, if we get those yellow trend line break levels. But I've got to wait till after the Fed. If they happen today, I'm not going to go full short because then we've got the Fed tomorrow. Okay, I think that all makes sense, hopefully. Okay, and then the most recent post, that was the post before the last one I made last video. I follow junk and it does not seem to have the same behavior on the PPO. If anything, the PPO signal line for junk is past testing from above. Yes, the charts are, of course, similar between junk and LQD. What do you make of it? Okay, first of all, JNK is one of two major junk bond ETFs. This is, its name implies, in junk bonds, so you know what they are. They're corporate bonds. They're not necessarily pure garbage. They're just anything below a triple B rating, means they have a higher risk of default, and of course they pay a higher rate of interest for it. LQD is the investment grade corporate bond, and so let me share what I made of that and give you my reply, because this is kind of the gist. There are two main things in the video. I'm going to talk about bonds, the bond market, and talk about inflation, and because that has everything to do with what happens tomorrow with the Fed, or almost everything. So my reply to that question above about junk and LQD being very similar, and my reply, exactly, that's the thing. The charts are similar between JNK, junk bonds, and LQD. Yet the majority of the leading indicators have been falling to levels indicating a good chance of an impending recession, or possibly that one may have already recently started. And just the recessions are always declared officially in hindsight. So you're not going to know. Kramer isn't going to tell you, whoever your favorite CNBC person, or even the NBER, the government agency officially for, the one for reporting and declaring recessions, they're not going to tell you until after it's happened. So just know that. So anyways, we'll get to that later. Bottom line, here's this. Credit spreads are at unusually low levels that have very little risk priced in. So either they, meaning credit spreads in the market, are right, and 2024 is going to continue to hum along with moderate to strong economic growth, or we're going to see a significant spike in spreads with junk and even LQD, put a little asterisk there, significantly underperforming Treasury. So, okay, it is my take based on my background in fundamental analysis, as well as technical analysis. Again, it's the vast majority of the leading economic indicator, the leading indicators, the ones that I trust, know, and have worked so well. I'll get to that in a second. So those are rolling over. There's a big dichotomy right now between not just what the stock market's doing, guys, this is the point here, but the bond market too is priced for perfection. They are priced for, okay, all right, Powell, right, he's not going to give us March for the rate cut, but he's still going to give us a flood of cuts later on, and he's not going to cut because the economy is going down. The economy is strong, he's just going to give us cuts anyways. That's just kind of almost, well, look, it all depends on the next part of the video, inflation. All right, so why did I put a little asterisk by there? And why would I say, okay, because credit spreads are measured. They're the differential between junk bonds and treasuries, which are the safest of all investment grade bonds, right? So why would I expect investment grade corporates to significantly underperform? And there's a key word too, guys. I didn't necessarily go down, although I think they will go down in price. But underperforming just means if treasuries were to rally next year or you're going forward, then corporates rally less. They've been moving in lockstep. So I think you'll see treasuries outperform. Now, that can also mean that rates rise. Like I think over the next year or so, treasuries go down in price because the yields are going up. But then corporates, both junk and LQD, go down more. They drop more in price. Yields go higher. Okay, now why? Why would you say that? These are investment grade, LQD, just like treasuries are investment grade. Well, yeah, but no. So LQD has what I would consider a dangerous amount of triple B rated paper in there, bonds, one notch away from junk status. Bonds, they have triple B at nearly half. So of LQD, folks think they're buying they're buying an investment grade corporate bond. But I've read over the years, in recent years, there's been a tremendous amount of issuance in that lower tier tranche, that the triple B rating, which again is one notch down, just one tick, one you can be downgraded all the way from single A down to triple B in one fell swoop, or single B, double B. It depends on downgrades aren't always incremental to one notch down. But again, let's just say that they do get. So here's what happens. So again, nearly half, 45% of LQD is in triple B, which is just a notch above junk. 47%, even more, closer to half, is single A, that's two notches away from junk, with only a 1% of the bonds in LQD, AAA rated, and 6% AA rated. So here we go. So as such, if, nay, when the economy, that's supposed to be economy, starts to turn, and especially if it starts to roll over faster than most expect, or, okay, that's one thing, watch the economic indicators, and or there's a major credit event. See, that can come instantly almost, as we know. I know I've been doing this a long time. You have, if think back to the financial crisis, all the, how quickly things unwound there. The regional bank crisis, we didn't know about it until it was a thing. And then, Silicon Valley blew up, and two more. So my other or is if there's a major credit event, that would be a credit event. Could be a broker dealer, money market fund blowing up, anything there. Then that huge issuance of triple B paper will be downgraded to junk. In which case, and then what happens there, so LQD is very big, and there's a lot of paper. Remember, the bond market's bigger than the stock market. You add up all the bonds out there, all the debt, it's bigger than adding up all the stocks in the stock market. So you get, if things happen quickly like that, in one fell swoop, you're going to have a shite ton of triple B bonds downgraded to double B. Okay, so yeah, LQD, and so what happened? Two things happen. Number one, instantaneously that bond loses value because it's priced in. It's not in default, but it's priced in now, higher credit risk. So right there, LQD would take a massive hit because half of their paper, and then a lot of these single A's might go down to triple B. Okay, so that's one thing. But what's more important, LQD is a investment grade. It's an ETF that holds investment grade bonds. So if you dig down in the prospectus, it's going to say that they can't buy junk paper and they can't hold junk paper. I don't know how long they're allowed to hold it, but it's not very long. So again, if this happens in that fashion, again, this isn't a hard prediction. It's something I think is very likely, and it's it's something I think will happen. But as of now, I'm highlighting it more as a get ready and react if it does. It may not happen. That's certainly a possibility. But if it does, it can happen quick. You get those sudden downgrades, and then they are forced to sell. And and by the way, just because LQD, and I talk about it because it's an ETF, easier to track, there's an enormous amount of bond funds in everyone's 401ks. All the 401ks out there have bond funds usually. They have prospectuses too, and in most of those, they're going to say the same thing, that they can hold 0 to maybe a small percent of junk paper. So what happens? You have a massive rush for the exits. And again, if it will, let's say you were managing your own money individually, you might want to wait that out and hold that paper. You have a guaranteed coupon as long as they don't default, even though the price would drop, you could hold on your books. They can't. When you're governed by a prospectus, you have to sell, and everyone will be selling at once because there's so much. And again, historically, you didn't have this much triple B paper hanging on the edge there. So they all get sold at once. There's more sellers than buyers. Prices go down, and I'm sure the market's saying, well, don't worry, the Fed will step in, because that's what they did back in when COVID hit. They stepped in. They invoked these obscure emergency powers that they had in their charter. They weren't supposed to be doing this, but they ended up historically they can't. But they end up buying these same things. They bought the angel bond ETF. They bought junk bond ETFs, and they stemmed up the market. And that's, I think, the thought process here. That's why I suspect credit spreads are so tight right now. But again, the Fed doesn't have the dry powder they used to with their balance sheet, which is already swollen to huge proportions. So, all right, I probably spent too much time on it, but I think it's super important. And again, something to watch and react to, because if it starts to develop, it's going to happen very fast. And by the time you realize what's going on TV, they're not going to tell you. You might want to have, 1 second here. Yeah, you may want to move some money out of your, investment grade bond funds and your 401k, or believe me, and where it all kind of goes down to too is the stock market. You see a credit event in the credit markets, that's going to be what roils and finally sticks a knife in this rally here. All right, that's that. So again, there it is. I went on to say time will tell if that happens or not, but a real risk to watch for, in my opinion. All right, what is this one? All right, here's another one that kind of segues into that. Member Reloaded said, Saturday night I was playing with the IEF charts and came to realize something intriguing. IEF, which is a 7 to 10 year Treasury bond, the one I cover all the time, is at about the price it was back on September 20th, 2023, when the Fed maintained 5.5% federal funds rate with no hike. And as of Saturday night, it was 2.87% lower than when rates were hiked to on 5.5% back on July of 2023. So let me just see the rest here, make sure I didn't miss anything. So in my novice opinion, if we're going to get even to a 25% rate, quarter point rate cut, I'd expect IEF price to be equal to or whatever that day. No. Okay. So first of all, great question, by the way. That's why I'm focused on this. First of all, no. So this often, the Fed controls the federal funds rate, which is an overnight lending rate for banks to use. They do not and never have and cannot fully control the 10-year. They can do their best to expand, contract balance sheet, quantitative easing, but at the end of the day, these are set by market forces. So number one, it's relevant. And then number two, more importantly, that's where I talk about quite often, I haven't done it in the last week or so here, is that thing we call the yield curve. So so this shows you the yield curve is all about just that. So while the yield curve doesn't compare the 10-year to the federal funds rate, they do compare it. You can look at, generally you look at the 10-year Treasury bond yield compared to the 1-year Treasury, or the 10-year compared to the 2-year. And you can get this. This is on Guru Focus. I use this. I like this one here. There's others out there. And again, this is public info. Talked about a lot. It's well known as being one of the most accurate predictors of a recession with a 0% failure rate. In other words, a 100% success rate, at least for the last, in modern history, really going back, it's predicted the last 7 recessions. And nothing's perfect. Maybe one day it won't. You might say, oh, Randy, you talked about the yield curve inverting, gosh, what was it, a long while back. And oops, get back to that. I'm trying to slide it over for you. There it is. And then I followed up to say, it's not the inversion. Hopefully you can see this in the video. The inversion is when you cross below the red line. That's when what happens, and this is the 1 and 10 year. That's when normally the longer you out in time on bonds, the higher the rate. That's because you're locking your money up longer. So you're going to demand a higher rate. So normally at any point in time, the 10-year pays more than the 1-year bond. Only time it inverts is heading into recession. Why does it do that? Well, because long-term rates start going down from the market's expectation, the economic growth is going to be slower, therefore inflation will be lower, therefore interest rates will be lower. So then they start, longer-term bonds, due to market forces, start paying a lower rate, but yet interest rates are still high on the short end because the Fed hasn't started cutting yet. Now, again, so the inversion always precedes a recession, but if you want to sharpen your pencil and look more for a timing indicator, it's what they call the uninversion. I know it's not, they don't use the term reversion, it's uninversion. The shaded areas, hopefully you can see that. So there was your uninversion. We back tested it there, came back to the zero line that did the trick, recession. And so this kind of answers, by the way, I'm not kind of going off on a tangent. This goes to that question about why is the 5-year or the 10-year now where it was when the federal funds rate was 5.5. This, you can see we're coming back up. We have not uninverted yet. Let's go down to the 210. Here's the 210. But we're very close. Let me zoom in a little for you on this. Let's go down to 5 years. So you can see this is why. So this answers that question. Because now we're starting to see, and what it is, and the reason it's the uninversion is because the Fed anticipates, they see the same economic indicator, hopefully, that I see. And they know things, the economy that, looks like the crosshairs are there for the next, contraction, whether it's going to be mild, severe, whatever the economic indicators are showing that. Why else would they be cutting rates? They're not to their, all their targets. So therefore, they're taking short-term rates down, which makes the differential start to go up. So that's why. So that's why don't confuse what the Fed funds rate is with the long bond, and also it's a function of this. And so when we uninvert, what it'll be is the Fed funds rate sooner or later this year getting cut, going down, and even if the 10-year IEF stays where it is, that makes this line go up, right here. This one, I should have used a darker arrow, but I think you know what I'm saying, because then you have the spread now increases, the differential between the shorter term bonds. Again, I know the Fed funds rate isn't the 1 or 2 year Treasury, but it's much closer because it's shorter term. Okay, guys, hopefully that makes sense. And there it is. So, the writing's on the wall. And this is, if you remember, if you followed me for a while now, before this, what I believe is still a bear market that started back in 2021, early 22, is that. And what I had called for then, and I've continued to call for, and that's why I kind of view this as a bear market rally instead of a new bull market that we're in off the October 2021 lows, 2022 lows, is that I predicted, and there's a lot goes into this, the technicals as well as fundamentals and many things, a much, much, much different bear market than any out there are talking. Well, there's others, but most aren't talking about. They're used to the bear markets we've seen for the past 4 or 5 decades, which were pretty much over before you knew it, with an average span about 16 months, year and a half, not even 2000 dot-com bubble, as bad as it was, the 2008 financial crisis and all those. And I expect something much longer and protracted, much closer to Japan's lost decade, which kicked off in the early 90s. And so therefore, that's why I think we're seeing this taking longer to play out. The inversion way back here, when you go back again, you're going to go back in time, you can see, inversion and uninversion. Inversion, uninversion. This one's a lot different so far. And again, it's just taken longer to play out. And so that's it. So, okay, that's all long-term stuff. There's no, even if it uninverted tomorrow, it's not like take everything out of my 401k. It's more of a guide of where we're going longer term and when this economy is finally going to roll over. And again, that'll be it. You start seeing Fed cut rates. And there's another chart. Oh, gosh, I have to pull it up for you. I've shared it before, but let me just pull that one up real quick. Okay, and this one, again, covered it many times in the past, but it bears repeating. Always new folks on the site, or those, throw out so many things, it's hard to remember everything. This is a federal funds rate historic chart. So here's where we're at right now. And let me change an arrow color here. All right, shaded areas. Hopefully you can see them. If not, you need a better quality monitor. But these are gray lines. Some are bigger than others. These are all recessions, the shaded areas. And as you can see, and so for those saying, oh no, we dodged a bullet, no landing now. This is how it works. Rates go up, and it's when the Fed starts cutting. If you look closely, hopefully you can see it in the video. I'll clear it out and we'll zoom in a little bit. The Fed usually starts cutting just before the recession officially starts. They stopped there. They held rates steady, which they're doing now. See how it was going up, 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 up. They stopped at 5.5, and they're going to hold tight this month, most likely, and then start cutting. That's priced in, and the Fed will not do it again. They will, you're going to get a cut soon, probably at the next meeting, I would all but assure it. And, if there's anything, major credit event, you'll get an inter-meeting cut, and that'll just spook the crap out of the markets. But all right, guys, you can see it. Rates stopped right here. They were going up. They peaked, Fed started cutting, then came the recession. Rates peaked. You have to look closely, but it was going down first before the gray line, then the recession. Here, rates peaked. There was a little recession, mild one with the bigger one there. Rates peaked. There's another one. Rates peaked after a rate hiking cycle. They started to cut, then came the recession. Rates peaked after a rate hiking cycle. They started to cut, then came the recession. Rates peaked, went flat for a while. Then the cuts came, then came the recession. Rates peaked, they started to cut, then came the recession. Quick one, but it was there. It was a line there. Rates peaked. There is a mountain of evidence I'm looking at in this and all these other charts I cover that show it's coming, and that the no landing folks are just wrong. They're just, everyone, you got to be patient in the cycle. Again, it plays into my analysis of both fundamental and technical analysis, that it's just it's going to be a slow roll, and but when it comes, it also formulates, how am I going to trade the next correction or bear market? Am I going to put on some swing positions that might last a lot longer? And again, I know I'm an active trader. Even if I foresee the market's doing this over the next 5 years, I'm not going to be short from here to here. Even in my swing accounts, I'll be short and try to game the major counter trend rallies along the way, because they're going to be powerful. And by definition, they're going to be bull markets if you want to use that old 20%. That I promise, because the drops are going to be well in the double digits and the counter trend bounces will be 20% or more. And I don't like riding out shorts for a 20%, bear market rally. All right, last one I wanted to get to, the kind of, again, I told you it would relate to interest rates. This one. So, and again, those two posts prompted me to do this last night. So this is TNX. Let's see where I have it for you. No. I will. We'll get to the 10-year. This is USO. So now for months I've been saying, keep it on crude, keep it on commodities. I think this whole abatement, Fed won the battle, mission accomplished with inflation. To me, again, I'm looking at bigger cycles. I'm looking at the technicals. I made the case that commodities as a whole had completed a bear market that started back in 2008 and ended at the March 2020 lows when the stock market bottomed with COVID, which was unusual because usually commodities and the stock market go together. And again, I've covered this many times in the past. By every metric used, commodities are in a new bull market. Those metrics being higher highs, higher lows, primary downtrend lines being taken out. We're still well above that. So that is still my view. And that's going to just make things very, very difficult for the Fed to return to that easy money policy, zero interest rates that the entire stock market seems to be expecting. When you look at valuations based on, when you look at earnings compared to interest rates, P ratios and all that, we're at some nosebleed levels. So, but nothing matters more than crude oil. And it's the one thing, like I said, I love watching it, not only because it's probably has the biggest impact on inflation, and it permeates down. It's not just the price of a barrel of crude or a gallon of gas you put in your car, but the plastics that are made, that are, everything. You're looking at your computer monitor right now, your shipping, transportation, goes in everywhere, permeates through just about all aspects. Even Farmer Brown harvesting wheat, he's not running that combine on sunshine and daisies. It's taking diesel fuel and as are a lot of the products there that they have. So anyway, that's a big one. And so I've talked on that lately, and I've talked on the fact it's been bullish and highlighted this 74 level. I've highlighted this uptrend recently quite a bit. That we're in, and there's no signs of it stopping so far. And I'll be honest with you, I'm surprised that the market has been, especially, remember when I said I said if it broke over 7, took out 74 with conviction, that's where the market would start to take note. I consider it my yellow zone, if you will. We're here now. Right now, the market's in a holding period this week because of the Fed. Otherwise, I think it would be poop in the bed right now, is in my opinion, based on this. Okay, so why, Randy, you're reading too much into crude oil. Well, let's do this. Let's flip over to this board. We're looking at crude, and now let's compare it to the 10-year Treasury yield. Nope, that's not it. TNX. Where's my dollar sign? T and X. Oh, dash TNX. Ay. TNX dash. There it is. Okay. So what do you see here? So again, in orange, we have crude oil. And I'm going back, and I'm only going to go back a couple years because it matters more now than at any point in decades. Just about any point in anybody's and anyone who's listening to my voice, most people in your lifetime, because we haven't seen inflation. We've had the hottest inflation in a half a decade. We're just coming off again. So it matters now immensely more than it mattered 5 years ago, 10 years ago, 15 years ago. So crude is everything. And so if you don't believe me, here it is. So here's the 10-year chart. Again, we can go back as far as we want, and it mattered back then. Look at this correlation. It's amazing. And it's almost nearly immutable. And again, you don't want the lines to overlap when you're looking at the correlation of two completely separate asset classes. One of these is a commodity, and one of these is the interest rates on government bonds. So about as far away as two different asset classes can be for what they are, but their correlation is unmistakable. And more so, okay, so I'm showing you a correlation. More so, there's some predictive value here, because if you look, and I'm doing it for you here, this is when crude peaked. And then this is when treasuries peaked, the 10-year treasury yield. Remember, I'm looking at yields. Bond prices work in reverse. These are interest rates. Crude started falling. Treasuries got the memo after that. They started falling. They continued to fall. Crude started to rally. Didn't pan out. And then boom. So other than that, and again, that was all pre-COVID. And remember, we didn't have the inflation before COVID. Since then, since inflation's been a thing, you see a extremely strong correlation. And again, there's predictive value. If you look here, in many cases, you would see crude prices peaking first or bottoming first. And so here's a case where treasury yields are going up, and you can see the inflection points there and there. Here's a bottom in crude oil right there. Crude started going up, another bottom, very high correlation, but right there, crude peaked. This is that whole recent thing. This is what the last leg up in the stock market was all about, falling inflation. Actually, no, I take it back. It was back here in 2022. This is when crude peaked, fell, and you can see, and we know the stock market did very well because inflation was at bay, interest rates stopped going up so much. But then remember, we had a surge back here in crude. And that's when treasuries hit a new high. And if I put this here, I'll do it. I can fit one more here. Edit chart properties, comparison. Let's put up the stock market now in green. So there it was. The crude prices started to have a rally, and they took out a previous low. And that kind of called into question that downtrend. Stock market had the biggest drop that it had in a couple years right there because of that. Okay, and remember, we came into the year, we shorted that, and then we went long in the beginning of the year. Was that that was QQQ? I'm sorry, and it was a different chart. QQQ was had a big difference there. Here we go. So crude peaked, then treasuries peaked, treasury yields started falling, and let me turn off the S&P 500 right now just to not make it so busy. And you can see the S&P is near highs. So this is it. Crude peaked. Then treasury bond yields peaked. You cannot deny this correlation. I don't care who you are. Then right here, as I just talked about, and been talking about for the last few months, crude bottomed, has entered a clear uptrend, and then, as expected, and we were trading treasuries and turning them, yields bottomed, and yields have been moving up. And look at this, almost in lockstep. However, look at this differential here. Crude had that breakout I just talked about, and this advance is starting to gain traction. The S&P or the treasury yields are back where they were. They're not following this up. So, well, one of the two is going to happen. Either treasury yields are dismissing and shrugging off this rally in crude oil prices, which has been such a big impact on yields before, as I just showed you, going back the last couple of years. And so somehow they know crude's going to fall, and that'll support this, or we're going to see rates rise and catch up. And in the past, that's been the case. If crude starts to run, yields start to go up, Why? Because it's inflationary. It's that simple. And that's predicting higher inflation. If bond traders expect inflation going forward, they're going to demand a higher rate on their bond. And so anyway, I wanted to show you because it's pretty compelling. And all you have to do, well, we'll watch bonds too. It's not all you have to do. We watch bonds closely. You guys know my IEF, yellow zone, orange zone. It's a 60-minute chart. Look at that. And a couple things. I'll wrap the video up here. It was great support there, enough for me to raise my orange zone to that level. This is a no-brainer. I mean, you hit it, we bounce. It's pre-Fed, just like the stock market just hit. Look at that perfect tag of that level. You know, this is technical analysis, and it's still it's even more important now than it was back here when I identified it and raised that zone, because now we have another distinct reaction. So it makes it more visible and obvious to bond traders and others out there. And remember, it's all about interest rates. That's why it's the orange zone. If we drop into this orange zone, the deeper we get in there, the more the market's going to freak out. And I think it's going to freak out pretty well. This is the freak out, red zone. Orange zone will start to take note. I see even even a lot of typical permabulls right now are saying, yeah, we need a 10% correction. We're going to get that soon. And that's where I think it'll be the WTF moment. If bonds enter, this will account for your 10% correction, probably. If we get down to my bottom of my yellow zone, is my guess. We get to the red zone, and that's where they're going to be like, WTF. The dip buyers are going to step in, gobble up a 10% correction. Everyone that's been wanting to get on the NVIDIA train will jump in, and that's where I think you'll see that bounce, that rally get sold into, and then you'll start to see support levels that should, quote unquote, should be holding on pullbacks, getting taken out. I might be getting ahead of myself, but that's what this site is all about. Presenting, okay, how am I going to trade? Because things can and do move fast, and I'll leave it with that. When you are a bull and long, and that's all you do alongside trader, you need to be aware, as you do if you're a short seller, even more so, that stocks tend to fall a lot faster than they rise. So if you want to be a successful short trader, you got to be on your game. And a bull market takes years to build up gains, and a bull market run, and usually those gains that took a year more to be produced by rising stock prices, they're wiped out in a matter of months, sometimes even weeks. And so that's why I give you this in advance. So if you see something happening post-Fed or 3 months from now or 6 months from now, check these levels on yields, check those yellow levels on the big former Mag 7 stocks, the key support levels they have, the key sectors of the S&P 500, and then you'll know, in my opinion, is it time to short or is it time to buy a dip? Speaking of buying a dip, which I think I covered earlier in the video. If not, I started to on that 60-minute chart of QQQ. This is where I gave you yesterday. Yeah, the pullback. I just wanted to reiterate, just like on IEF, which also at the same exact time, and there's the thing, if you see IEF and QQQ both fall to comparable, very key support levels at the same time, that's a no-brainer, especially pre-Fed. You're going to get a bounce. So there was, and that's why I had on yesterday's short-term setup trade, the white arrow going from here to here was a break. That means a reaction. That was time, so you could have shorted there, swung it down for 1.7% gain, reversed it, and gained a 0.4% bounce. But as I told you, at this point, we're getting very close. We have now just over 24 hours before the Fed announcement. So you might start seeing some whipsaws. It's not a bad time. And I'll probably take the rest of the day off after doing this video. I just wanted to kind of get all this out to you. So there it is. Levels to watch. These recent lows. It's last Friday's lows. It's also now today's lows. Is that it? Yeah. Friday. Yeah. Last Friday's lows. Today's low. Same thing on IEF. Those two alone. You can set price alerts on these if you want. IEF, takes out 93.45. QQQ takes out, 44.33 or a little bit below it. And if it takes it out post-Fed, especially if we're really down through there, remember there's always a chance of a post-Fed whipsaw. Unfortunately, you just can't rule that out. You either sit and wait and don't take the breakdown and wait to see a solid move down below there Friday or next Monday. Only problem with that, we could be down this far by next week, or we could be all the way up here. if these levels hold and Powell tells the market what they want to hear, and all these yellow levels I've been highlighting on Apple, Amazon, Microsoft, Nvidia, Meta, they all hold, that's where we go. So I'm going to wrap it up here. You've got the levels. You have kind of my rough plan, what I'm going to do, and you guys can take this analysis, incorporate it into your own. And if you're bullish, like I said, that's what I believe I excel in, is identifying key important support and resistance levels that are likely to produce reactions, and where bulls, if bullish, can go long on pullbacks too, and bears, if bearish, want to get short, they can wait for those levels to go. And also bulls can buy there and use a stop somewhat below, and the bears that short the breakdown can short and use a stop somewhat above in case it's a whipsaw. I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.